Good evening, all. Eric Mashinsky with the Gold Investment Letter tonight. Just wanted to give you all a little bit of information on my thoughts via video versus typing up a longer report. Been doing a lot of research recently on gold and where we are in the global economic landscape, how this all ties together, and just sort of a larger viewpoint of where we stand in this very interesting global environment. The reason for this too is because as we close out the year, I just wanted to even show verbally, some of my convictions around what I believe is that we are very, very close to the end of the gold bear market. We've been going on 5 years this spring, and gold itself is not quite cut in half or down 50% from its highs back in 2011. But when you look at the gold miners, we are in the worst bear market in history in terms of severity. And in February, we will pass the longest in terms of duration. What's interesting about that is that in the past, when we've had a severity decline anywhere near this level, it was done very, very quickly, and the duration was not long. If the duration was long, the severity wasn't as bad. So right now, we literally have got a bear market in gold miners that is, it's the worst we've ever seen. And these are the types of markets that whether we are a month away, a year away, 3 years away, this is where you get the bargains. I mean, I look at the stock landscape and the bond markets. Stocks can't seem to break into new high territory. I think there's certainly some lethargy going on, at least in the general stock market, as we await the Fed's decision on raising rates in December, which looks very likely. Bonds have been in a bull market, the biggest bull market in history, for 36 years. I would avoid bonds completely at this juncture. Very, very last squeezes out of the orange, if you will, in that marketplace. It just, risk reward does not make any sense. I was doing some research recently on just global numbers, and what's interesting is that from a global government debt standpoint, here are just a few statistics to keep in mind. We've seen global, let's take a step back and just look at production, global GDP. Global GDP is approximately $78 trillion. That's the entire globe and what we produce on an annual basis. The United States is good for 22% of that. That's down from a high of 40% back in 1960. 55-year average is near 30% of the global GDP. When you flip that around and look at the global debt levels, I think there's a couple things that really stick out to me now with all this money printing, is that we've got global debt in 2014. It's a record, $62 trillion in global debt. It's tripled since the year 2000, which is amazing. America has gone from 29% of the global debt balance up to 37.5% of that number currently. So interesting, just macro pieces. But one of the things that I think is going to be interesting is looking at the amount of debt that the U.S. has, and when the Fed starts to raise rates, people really aren't talking about how the servicing of that debt, the costs are going to be driven up substantially. We're already, I don't have the statistics with me, but we're already at a point where the numbers are mind-boggling in and of themselves. When you start to raise the debt, they're basically, our government is going to be raising the debt on themselves, which means to me that I don't think we're going to be able to see a very strong rising rate environment over a period of time until we run into more problems. But let's just say that we do. I think one of the misconceptions out there is what happens with gold in a rising rate environment. I pulled this from the National Inflation Association. They have some really interesting statistics lately. And since the end of the U.S. gold standard in 1971, there have been three major Fed rate tightening cycles. The first one occurred between February 1972 and September 73, when the effective Fed funds rate increased by a total of 749 basis points from 3.29% to a high of just over 10%. During the 19-month Fed rate hike cycle, the price of gold increased from $47 per ounce to a high of $123 per ounce, with a peak gain of 162%, versus the S&P 500 simultaneously making a nominal decline of 2%. Priced in terms of real money, gold, the S&P 500 declined by as much as 62% in 13 months. That's just pricing that movement based on the price of gold versus the US dollar. The second rate hike cycle occurred between January 1977 and April 1980, when the Fed funds rate increased by a total of 1,300 basis points from 4.6% to a high of 17.6%. During this 39-month Fed rate hike cycle, the price of gold increased from $129 per ounce to a high of $850 per ounce, for a peak gain of 555%. Gold gained 46 times more than the S&P 500, which simultaneously made a nominal gain of only 12%. Priced in terms of real money, S&P declined by as much as 83% in 36 months. The third major Fed rate hike cycle occurred between May 2004 and August 2006, when the effective Fed funds rate increased by a total of 425 basis points from 1% to a high of 5.25%. During this 27-month cycle, the price of gold increased from $375 per ounce to a high of $654 per ounce, for a gain of 74%. Gold gained 4.5 times more than the S&P 500, which also gained 16%. Priced in terms of real money gold, the S&P declined by as much as 34% in 24 months. During the previous three major Fed rate hike cycles, gold achieved an average gain of 263% versus the S&P 500 averaging a nominal gain of only 8.69%. Gold on average gained 30 times more than the S&P's nominal gains. And the S&P priced in terms of gold declined by an average of 60%. So what I'm getting at here is digging into the rising rate environment that it looks like we're going to get into, whether it's modest or it ends up being a long-term trend. There's a misnomer that gold gets hurt in that environment, and it's just simply not true. So we are in a position, when I look at the investment landscape, that shows us we've been in a 5-year bear market in gold, silver, and mining stocks. We've seen an environment in stocks that have gone up for 6 straight years. We just finally had a 10% correction this summer, the first of which we've seen during this bull cycle. We have a bond market that's 36 years old in terms of the bull cycle there. And we can't get paid anything in cash from the banks because the Fed has not been able to raise rates for 7 years because of the fragility of our economic environment. The reason I launched the gold investment letter in 2011, all of the reasons why I decided to focus on a niche market like this versus just a general stock newsletter or investment newsletter, every one of those reasons is not only still in play, but they're just expanded dramatically from when that time was. We had, I think, we're having a very normal decline in the middle of a cycle, a secular bull cycle like we saw back in the 70s. I talk about it a lot. Gold went from 100 to 400, got cut in half to 200 in the middle 70s before it rocketed to 850. And from a percentage basis, that would take gold just below $1,000. And I think that's our downside. You know, if we get around a 50% cutback from the highs back in 2011, say we're looking at 950 gold, possibly that flush below 1,000 that scares the last of them out. You know, it's not very far from where we are today. You're talking about a 10% downside. and the upside is tremendous. Um, I'm not going to go through my predictions of where I think gold is going to go ultimately, but I've said it time and time again that it's around 3,000 an ounce based on cutting the percentage move in half that we saw from low to high in the last bull cycle in the 1970s, when today you could argue that it could be 5 or 10 times as more powerful as we saw in the 1970s. Now is a good time, I believe, for investors to really start to look at your holdings. Um, you know, it's clear to me, at least in my perspective, that gold is building a bottom, and the gold stocks are building a bottom. It's a process, and it's happening fairly slowly, uh, but this market is going to end up taking off again. And we're going to see money flow back into gold, silver, and the mining stocks. I don't know if it's really going to start in earnest next month or if it's going to be another year. Um, I was talking to a CEO of a publicly traded gold company, and I said, they were looking to sell the business. And I said, I don't know if the new bull starts in a month or in 3 years, but I believe it's going to be a lot closer to the month than it is to the 3 years. That said, you have to accumulate and buy stocks when they're down if you want to buy low and sell high. It's a difficult thing to do. It's something that I think a lot of us who've been patient in this bear cycle have been happy that we have been and not gone all in, have had defenses up, hedges, things like that in place. But now it's time to get more involved. I think that some of the action in the gold market has really improved recently, and we are seeing a bombed out sector in the miners. It's bombed out. I mean, everybody who was going to sell, except for the last trickles, I think have puked this thing out. 2011, when everybody and their mother rushed into gold and silver, a lot of those people, most of those people are gone. This whole thing just really comes down to your perspective. For me, when I started buying gold initially, the first gold I ever bought was in 2003. I think it was around $400 an ounce, somewhere around there, 450. And so even right now, those purchases, even though it was over a decade ago, are still up. It's a triple from there. But if you just rushed in based on the media and hype and all the attention that gold and silver were getting in 2010 and 11, you're smoked. Now we're back at a point where everything is cheap, and it pays for me to recalibrate my thinking and look at a market from a fresh perspective. There's a lot of danger signs out there in the world. I don't know what's going to happen. I hope we continue to muddle through. And I would love for things to continue on in a bull cycle for the general stock market. Gold and the miners can absolutely trade in tandem with a good market, as we saw in the 2000s. But the fact is that just isolating gold and silver in this cycle, it is very long in the tooth in terms of the bear cycle, and a new bull market is going to start at some point. A couple of ideas that I just wanted to reiterate for people is that when you're looking for yield out there, my favorite position remains to be, and I just bought some more yesterday and today as it's testing its lows again, the Gabelli Global Gold Natural Resources and Income Trust. The symbol is GGN. It's trading right at $5. And at these prices, we're in the 16%, 15, 16% annualized dividend, where they just confirmed for the first quarter they're going to maintain a 7 cents per month cash dividend. This is just a really good way to get some yield and also some potential capital appreciation as we go through a new bull cycle. It's they generate this income by writing covered calls against various mining stocks. They've been consistent with dividends for a long period of time. This has been a $30 ETF in the past. It's at $5 now. It's the cheapest I've ever seen it. And I think it's a really good way for people to park a good amount of money to have some exposure to the sector and get paid for waiting, which is critical. The other thing I wanted to talk about today before I end is the fact that from a standpoint of an individual investor, We, in this day of algorithmic trading and dark pools and institutional money and speed and everything else, it's really tough for individual investors to have an edge. I'm convinced that we do have an edge in one particular arena, and that is in the small, micro, nano cap stock market, because these companies are too small for the investment banks, broker dealers, the research houses to get behind. From a capital raising standpoint, we've seen a real gap that's opened up to any, whether it's a Canadian miner or it's an OTC company here in the U.S. If they're raising less than $2 million in a private placement, it is extremely difficult. There are very, very few firms that are still financing those deals. They have too much risk, too much compliance and legal costs to really make it a profit center. And even if they do anything in that regard, they can mess around with the stock quite a bit and try to trade into their profits. And excuse me, there's a lot less liquidity in some of these names, especially the sectors that we follow with natural resources and mining in such a bad market. But I've found disconnects in valuations in some of these small company stocks because of the fact that the bigger money is not involved at this stage. That does not mean that they won't get involved in a much brighter marketplace, in a more bullish environment. And so what I look at when I'm taking a position in, for example, junior miners, if you've got $20 million in assets, you've got money managers, you've got alternative investments, private equity, all kinds of different things. Junior miners that don't trade a lot are tough to take real significant positions and make a difference. However, with the upside being as big as it is, I think it's worthwhile for people to consider some deal flow in that $50,000, $100,000 range, even if you're a very high net worth investor, for junior individual companies. And then what you need behind that is you need deal flow. For the individual investors that are accredited, but that's way out of your reach. You might have a few $1 million net worth, investable assets are much lower. And you like the idea of doing deals, but you don't have time for research, and you want to go ahead and put about 20 grand into 5 or 10 of these junior gold companies to build a portfolio. We've got a really interesting goal here and plan from my company, Phenom Ventures, and the Gold Investment Letter, which is that we've created Issuer.direct as a platform for small and micro cap companies to raise capital directly from accredited individuals in small pieces from $10,000, $20,000 minimums up to $500,000 tickets from larger high net worth investors. And we do the due diligence. We have started and are going to complete the first raise. It's a small raise for Patriot Gold. Many of you know that I really like this company. I hold almost 4% of the shares outstanding. I've invested low six figures into the company myself. But the advantage that we get as accredited individuals, for those of you that are, and for those of you that aren't, stick around, because in 5 months, the SEC has approved your ability to invest in private placements for the first time ever. And we're probably going to provide some solutions for the non-accredited folks vis-a-vis funds that will allow for low minimums, where you also get some diversification and can add to your investment over time. Individually, with just like a couple of grand, it becomes quite a nightmare with administrative things, but pooled together, it can be looked at as one entity. So this applies to you as well. This is cutting edge stuff regarding the Jobs Act and what is happening in terms of the face of finance and capital formation. It's changing and it affects all of us. But the reality is that when we pool together even $500,000, as little as 500 grand or $1 million as a group, we are able to negotiate terms that are advantageous to the investor. You look at Patriot, for example, it's trading at 8.5 cents if you want to buy it on the open market. For those of us that are able to put as little as $10,000 into the private placement, we get a 40% discount. It's at 5 cents. We have to hold it for 6 months, but it's worth it. It's worth taking the position all in one swoop. You don't have to worry about sitting in the market and trying to accumulate it. And believe me when I tell you, even if it's a couple of years from now, when gold is back near 2,000 bucks, little stocks like Patriot will have a much more liquidity, much more liquidity. So I would encourage you to check out the Patriot Gold Issuer Direct page. And even if you're not interested in Patriot, register on the site and get involved in seeing the deal flow that we have got coming. We've got 5 deals on the docket, on deck, coming forward from around the $500,000 raise level up to 1.5 million. And most of these deals are discount to the market and include warrants, which can really end up boosting returns. So I've gotten serious about this from a standpoint of I'm not writing $1 million or $500,000 checks for these individual junior gold companies, but I can do 50 and I can do 25 and I can do 75 for the ones that I like, and I want to spread that out across various deals in the landscape that I like, which is gold, silver, some of the possible energy companies in the future. Issuer direct is not exclusive to mining plays, but right now that's where the bargains are. So that's where we're focusing, and that's where my relationships are. So please do check out Issuer Direct. For those of you that have considered a premium subscription to Gold Investment Letter, premium subscribers get first look at everything that we do. We are raising prices in a few weeks. These prices that are there are going to go away, and I would encourage you to give it a shot and lock that in if you've been waiting to do so. That's it for tonight. Just some food for thought. Thanks for listening.